Something significant just happened in the silver market. A sharp, sudden movement has shaken the foundations of what many thought was a stable price range. For those watching closely, this was not just another day of market noise. This was a break. It was a tremor that signals a potential earthquake ahead. Many investors and industrial users felt a jolt of surprise. Some felt a wave of concern wash over them, seeing their holdings fluctuate wildly. Others, however, saw the volatility not as a threat, but as a rare window of opportunity. This event has forced everyone involved with silver, from miners to manufacturers, to pause and reassess the landscape. This essay will dissect that critical moment. We will explore what it means when a market like silver snaps. We will use clear, simple language to explain the complex forces at play. The goal is to provide a straightforward guide to understanding this recent shock. We will look at why silver matters so profoundly, who influences its price, and what specific factors likely caused this dramatic shift. Most importantly, we will outline what this break could mean for the future, presenting simple scenarios and clear signals to watch. The aim is not to create alarm, but to foster understanding and preparedness in an increasingly uncertain financial world. The feeling in the air right now is one of tense anticipation. The initial shock has passed, but the aftershocks are still being felt. Was this a one-time event, a flash in the pan driven by panicked algorithms and short-term news? Or was it the first crack in a dam that is about to burst? The answer to that question will determine the fortunes of many in the coming months. It is crucial, now more than ever, to look past the headlines and understand the fundamental mechanics of the silver market. By doing so, you can position yourself to navigate the changes, rather than being swept away by them. So, what does it mean when we say the silver market snapped? This is not a term you will find in a standard economics textbook, but traders and seasoned market watchers know it well. A snap is a sudden, violent price move. It breaks through established technical levels. Support, resistance. It moves far beyond the normal daily trading range. It feels less like a trend and more like a physical object breaking under extreme pressure. The market for a moment becomes unhinged from recent patterns, instability, and chaos. These events rarely have a single cause. Often it's a perfect storm of smaller pressures converging. Think of a dry forest waiting for a spark. A big news headline can be that spark. A single large trade by a major bank or hedge fund can push prices past a tipping point. A bottleneck in the physical supply chain can build hidden tension. When these combine, the price move can be explosive and self-reinforcing. The key trait of a snap is velocity. The price doesn't drift, it gaps up, or it plunges down. Modern high-frequency trading often magnifies that speed. These programs react in microseconds. One program triggering a large order can set off a chain reaction of algorithms. That creates a cascade of buying, or a cascade of selling. The price moves far faster and further than humans alone could. The market enters a feedback loop. The move causes more moves. Once a snap occurs, market psychology shifts. Floors that felt solid are irrelevant. Ceilings don't hold. A vacuum of uncertainty opens. Traders betting one way are forced to close at a loss, adding fuel. New buyers jump in. New sellers jump in. The market becomes a wild, unpredictable frontier. Understanding this dynamic is the first step to making sense of the recent shock. Silver is often overshadowed by its more famous sibling, gold. To dismiss silver as a minor player is a grave mistake. The white metal has a unique dual identity that makes it critically important to the global economy. On one hand, it is a monetary metal, a store of wealth that people have trusted for thousands of years. Like gold, it is seen as a safe haven, a way to protect purchasing power against inflation and currency devaluation. Investors buy silver coins and bars as a tangible form of insurance against economic turmoil. This role gives silver a baseline of demand that is tied to financial fear and uncertainty. On the other hand, silver is arguably the most important industrial commodity of our time. Silver is the most electrically conductive and thermally conductive of all metals, making it indispensable in electronics. Your smartphone, your laptop, the servers that power the internet all rely on silver. It is also a key component in the green energy revolution. Solar panels use a significant amount of silver paste to conduct the electricity generated by solar cells. As the world pushes for more renewable energy, the demand for silver in this sector is set to explode. Its applications do not stop there. Silver has powerful antimicrobial properties, which makes it vital in medicine. It is used in wound dressings, medical devices, and water purification systems to prevent the growth of harmful bacteria. It is also used as a catalyst in the chemical industry to produce essential materials like plastics, from bearings in jet engines to the reflective coating on mirrors. Unlike gold, most of the silver used in industry is consumed and never recovered, creating a constant and growing demand stream. To understand why the silver price can move so dramatically, you need to know the key players who influence it. The market is not a single entity. It is a complex ecosystem of different groups with competing interests. Miners, the companies pulling silver from the ground. They often produce silver as a byproduct of mining other metals: copper, lead, zinc. Miners' production sets the baseline for new supply each year. Disruptions at major mines, like a labor strike or a geopolitical event, can immediately tighten global supply. Industrial users, factories and tech companies using silver in products. They focus on securing stable, predictable supply at reasonable cost. Many use long-term contracts to lock in prices and avoid spot market volatility. When demand for end products like solar panels or electric vehicles surges unexpectedly, these firms must buy additional silver on the open market, which can push prices higher. Financial players, big banks, investment funds, and traders on exchanges like COMEX. They trade paper silver rather than take physical delivery. Futures contracts and options. Large trading volumes can create sharp short-term swings. A coordinated move by a few big funds can trigger a market snap when massive buy orders or massive sell orders overwhelm normal flows. Retail investors, from coin buyers at local shops to investors in silver-backed ETFs. No single factor can be blamed for the recent violent snap in the silver price. It was the culmination of several underlying tensions that finally reached a breaking point. First, a significant geopolitical news event acted as the catalyst. Escalating trade disputes. A sudden shift in a major central bank's monetary policy. Those headlines created a wave of uncertainty across all financial markets. Investors often flee to perceived safe haven assets in moments like these. Some rush to buy silver as a store of value. At the same time, large institutional traders sold silver contracts, fearing an economic slowdown. They were betting that industrial demand would fall. That clash of buying and selling pressure created the initial volatility. Fourth, exchange-traded funds played a big role. On the day of the snap, major silver ETFs saw unusually large flows. Large withdrawals can force ETF managers to sell physical bullion to meet redemptions. Large inflows force them to go out and buy physical silver. Those flows were significant enough to amplify the stress. News shock, algorithmic amplification, tight physical supply, large ETF flows. Together, they created the perfect storm for the dramatic break we witnessed. The immediate effects of the silver snap were felt across the board, sending ripples far beyond the trading floors. The most obvious impact was on the price itself. The market price of silver moved by an amount that would normally take weeks or months to unfold, all within a single trading session. For investors, this had a dramatic effect on the value of their holdings. Those who were positioned correctly on the right side of the move saw substantial paper gains overnight. Conversely, others were caught on the wrong side and suffered devastating losses. Traders using leverage faced margin calls that forced liquidations and added to the momentum. For industry, the shockwave created a new level of operational uncertainty. Manufacturers of solar panels, electronics, medical devices watch the price action with intense focus. A sudden and sustained spike in the price of silver increases their cost of production. That can squeeze profit margins or force higher prices for consumers, hurting demand. Even a sharp price drop isn't good. Extreme volatility ruins long-term planning and budgeting. Businesses thrive on predictability. The snap shattered any illusion of a stable price environment. The physical market for silver reacted instantly. coin and bar dealers reported a massive surge in inquiries and orders. Demand spiked for American Silver Eagle's 100-ounce bars, and premiums shot up. The premium is what you pay over the spot price, so the actual cost to buy a coin in hand rose, reflecting scarcity and logistical strain. Following a market shock of this magnitude, the future is uncertain. However, we can outline 3 broad scenarios for where the silver market might go from here. The first, and perhaps most common outcome, is a gradual return to calm. In this scenario, the market digests the event, and the extreme volatility subsides. The price may settle back into its previous trading range or establish a new, slightly different one. This is most likely if the snap was primarily caused by a temporary news event or a technical cascade of trading that has now run its course. The second possible path is a sustained rally into a new, higher price range. The snap, in this case, would not be an isolated event, but the starting gun for a new bull market. This scenario becomes more likely if the underlying reasons for the snap are fundamental and persistent. For example, if industrial demand continues to accelerate, particularly from the green energy sector, while mine supply remains stagnant. A genuine supply deficit could emerge. The third and most unsettling scenario is a period of continued and heightened volatility. In this future, the market does not calm down. Traders, now wary of the increased risk, might reduce their participation, leading to thinner liquidity. This would paradoxically make the market even more susceptible to large price swings from smaller trades. For industrial users, a nightmare. For investors, high risk, high reward, favoring only the most agile and risk-tolerant traders. Determining which of these paths is most likely is the key challenge. Watching the key signs in the coming weeks will be crucial. In the wake of this silver shock, remain level-headed. Focus on clear, observable data rather than emotional reactions. For investors, daily flows into and out of major silver ETFs. Large, consistent inflows suggest strong investment demand. Monitor open interest in the COMEX futures market. A steady rise indicates new money is entering the market. A sharp drop can signal that leverage positions are being unwound. For those in industries that depend on silver, focus on the physical supply chain. Watch production forecasts, potential labor strikes, shipping delays, and new environmental regulations that could impact supply. Monitor inventory levels at major commodity exchanges and premiums for wholesale 1,000-ounce bars. A rising premium signals the physical market is tightening significantly, even if the paper price isn't yet reflecting it. Dealers and collectors should watch the relationship between spot price and retail premiums on coins and small bars. When premiums expand dramatically and deliveries delay, retail supply is under severe strain. A major break can feel disorienting, but it can also reveal underlying tensions. The key is not to panic but to plan. Assess why you own silver and whether the recent events have changed your long-term thesis. The silver story is far from over. This shock may be the start of a new chapter. Stay informed, stay patient, stay prepared.